Hey everyone, and welcome back to the channel. Today we're diving into a topic that sounds like magic, but is actually just math, compound interest. We're going to explore how you can, over time, turn a single dollar into $1,000. Sounds crazy, right? Well, stick around, because by the end of this video, you'll see it's not only possible, but you'll understand exactly how it works. So, what is compound interest? Albert Einstein supposedly called it the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Simply put, it's interest on interest. Imagine you have a little money snowball at the top of a very long hill. As it starts rolling, it picks up more snow, getting bigger. The bigger it gets, the more snow it picks up with each roll. That's compound interest. Your initial money is the snowball, and the interest is the new snow it collects. Soon, you're earning interest not just on your original money, but also on the interest you've already accumulated. Let's break it down with our $1 challenge. We want to turn $1 into $1,000. That means we need our money to grow 1,000 times. To figure out how long this takes, we need to know one crucial piece of information: the interest rate, or the rate of return. This is the speed at which our snowball grows. Let's start with a hypothetical but very generous interest rate of 10% per year. You invest your dollar. After 1 year, you earn 10% interest, which is 10 cents. Now you have $1.10. Not exactly life-changing, I know. But here's where the magic starts. In year 2, you earn 10% not on your original dollar, but on your new total of $1.10. So you earn 11 cents, bringing your total to $1.21. In year 3, you earn 10% on $1.21, which is 12.1 cents, and your total becomes $1.33. You can see a pattern here. The amount you earn each year is getting slightly bigger. It's a slow start, but this acceleration is the key. So, how long would it take to get to $1,000 at a 10% annual return? Let's fast forward. After 10 years, your dollar would be worth about $2.59. After 20 years, it's about $6.72. After 50 years, it's grown to $117. It's picking up speed. To reach our $1,000 goal, it would take approximately 73 years. Now, 73 years is a long time. You might be thinking, great, I'll be rich when I'm 90. But don't get discouraged. This example uses just a single dollar and no extra contributions. The point is to show the raw power of compounding over a long period. What if we could find a higher rate of return? Let us say you're a savvy investor and you manage to get an average annual return of 15%. A higher interest rate is like rolling your snowball down a steeper hill. It's going to grow much faster. With a 15% return, how long does it take for our dollar to hit $1,000? The answer is about 49 years. We just shaved off 24 years from our timeline. That's a huge difference. What if we get even more aggressive and aim for a 20% average annual return? This is a high return, historically achieved by some of the best investors in the world over long periods. But let's see the effect. At 20%, our single dollar would cross the $1,000 mark in just about 38 years. Now we're talking. From 73 years down to 38 just by increasing the rate of return. This demonstrates the incredible sensitivity of compound growth to the interest rate. This whole turning $1 into $1,000 thing is a great way to understand the concept, but it's not a practical financial plan. Nobody invests just $1. So let's make this more realistic. What happens when you add more money to the mix? This is where things get really exciting. Let's go back to our 10% return rate. Instead of just investing $1 once, let's say you invest $1 every single day. That's $365 a year. It's like adding a little bit of extra snow to your snowball by hand as it rolls down the hill. You're not just relying on the snow it picks up on its own. If you invest $1 a day and get a 10% annual return, after the first year, you'd have about $384. Not bad. But let's see what happens over time. After 10 years of this, you would have invested $3,650 of your own money. But your account balance would be nearly $6,300. You've earned over $2,600 in interest. The compounding is working its magic. Let's keep going. So, how do you actually get these returns? Where do you find these magical 10% or 15% interest rates? Well, a standard savings account won't cut it. They typically offer very low interest rates. To get higher returns, you generally need to look at investing, most commonly in the stock market. Investing in the stock market might sound intimidating, but it doesn't have to be. One of the most popular ways for beginners to start is by investing in low-cost index funds or ETFs. These funds hold a wide variety of stocks like the S&P 500, which tracks the 500 largest companies in the US. By buying a share of an S&P 500 index fund, you're essentially buying a tiny piece of all those companies. This diversification helps reduce risk compared to picking individual stocks. Historically, the average annual return of the S&P 500 has been around 10%. Of course, this is just an average. Some years it's up 20%, some years it's down 10%. But over the long term, it has shown consistent growth. This is why time is your greatest asset in investing. It allows you to ride out the market's ups and downs and benefit from the long-term upward trend. The 3 key ingredients to making compound interest work for you are money to invest. Even a little bit helps. A good rate of return, and most importantly, time. The more time you have, the less money you need to invest and the less risk you need to take to reach your goals. This is why financial experts always say to start investing as early as possible. Even a few years can make a monumental difference in your final outcome. Think about 2 friends, Sarah and Tom. Sarah starts investing $100 a month at age 25. Tom thinks he has plenty of time and starts investing the same $100 a month at age 35. Assuming they both get a 10% return and plan to retire at 65, what's the difference? Sarah, who invested for 40 years, would have over $630,000. Tom, who only invested for 30 years, would have around $226,000. Sarah invested just $12,000 more of her own money than Tom, $100 a month for 10 extra years, but she ended up with over $400,000 more. That is the staggering power of giving your money an extra decade to compound. It wasn't about being a better investor. It was purely about starting earlier. So the lesson here isn't just that compound interest is powerful. The real takeaway is that the best time to start investing was yesterday. The second best time is right now. Don't be discouraged if you can only start with a small amount. As we saw with our $1 example, every little bit counts and consistency is key. Turning $1 into $1,000 might be a long game, but starting with $20, $50, or $100 a month can put you on the path to financial freedom much sooner than you think. It's about building a habit, staying consistent, and letting time and the magic of compounding do the heavy lifting for you. Open a brokerage account, set up automatic transfers, and start investing in a low-cost index fund. Then, be patient. Let your money snowball grow. Thanks for sticking with me through this deep dive into compound interest. I hope it's opened your eyes to what's possible. If you found this video helpful, do me a favor and hit that like button. It really helps the channel out. And for more content on personal finance and investing, make sure to subscribe and ring that notification bell. Let me know in the comments if you've started your investing journey or what's holding you back. Thanks for watching, and I'll see you in the next video.